Random House Audio presents The Future for Investors. Why the Tried and the True Triumph Over the Bold and the New by Jeremy J. Siegel. Read for you by James Lurie. My first book, Stocks for the Long Run, was published in 1994, when the U.S. market was midway through its longest and strongest bull market in history. My research showed that over extended periods of time, stock returns not only dominate the returns on fixed income assets, but they do so with lower risk when inflation is taken into account. These findings established that stocks should be the cornerstone of all long-term investors' portfolios. The book's popularity led to many speaking engagements before audiences of individual and professional investors. After my presentations, two questions invariably came up. Which stock should I hold for the long run, and what will happen to my portfolio when the baby boomers retire and begin liquidating their portfolios? I wrote The Future for Investors to answer these questions. In Stocks for the Long Run, I recommended that investors link the equity portion of their portfolio to broad-based indexes of stocks, such as the S&P 500 index or the Wilshire 5000. I had seen so many investors succumb to the temptation of trying to time the ups and downs of the market cycle that I believed a simple, disciplined, indexed approach was the best strategy. I did discuss some techniques that might improve on these indexed returns, but these suggestions were never central to the major thesis of the book. Although indexation was a very good strategy for investors in the 1990s, by the end of the decade I became increasingly uncomfortable with the valuations that were put on many stocks. I thought frequently of what Paul Samuelson, my graduate school mentor and first American Nobel Prize winner in economics, wrote on the cover of Stocks for the Long Run. Jeremy Siegel makes a persuasive case for a long-run buy-and-hold investment strategy. Read it, profit from it, and when short-run storms rock your ship, sleep well from a rational conviction that you have done the prudent thing. And if you are a practitioner of economic science like me, ponder as to when this new philosophy of prudence will self-destruct after Siegel's readers come someday to be universally imitated. When he wrote this in 1993, stock valuations were near their historical averages, and there was little danger that the market would self-destruct. But as the Dow Industrials crossed 10,000 and NASDAQ approached 1,500, stock prices relative to either earnings or dividends climbed to higher levels than they had ever reached before. I worried that stock prices had reached heights from which they would yield poor returns. It was tempting to urge investors to sell and wait for prices to come back down before going back into stocks. But when I investigated the market in depth, I found that overvaluation infected only one sector, technology. The rest of the stocks were not unreasonably priced relative to their earnings. In April of 1999, I took a stand on the pricing of Internet stocks by publishing an op-ed piece in the Wall Street Journal entitled, "Are Internet Stocks Overpriced? Are They Ever?" It was my first public warning about market valuations. Shortly before the article appeared, I invited Warren Buffett to speak before the Wharton community. He had not been on campus since he left the Wharton undergraduate program in 1949. He spoke to an overflowing crowd of more than 1,000 students, many of whom had waited hours in line to get an opportunity to hear his wisdom on stocks, the economy, and whatever else was on his mind. I introduced Warren to the audience and detailed his extraordinary investment record. I was particularly honored when, in response to a question about Internet stocks, he urged the audience to read my journal piece that had been published just a few days earlier. His encouragement persuaded me to look deeper into the technology stocks that were selling at unprecedented valuations. At that time, technology stocks were all the rage, and not only had the market value of the technology sector reached almost one-third of the entire S&P's market value, but trading volume on NASDAQ for the first time in history eclipsed that of the New York Stock Exchange. I penned another article for the journal in March 2000, entitled Big Cap Tech Stocks Are a Sucker's Bet. I argued that stocks such as Cisco, AOL, Sun Microsystems, JDS Uniphase, Nortel, and others could not sustain their high prices and were heading for a severe decline. If investors had avoided technology stocks during the bubble, their portfolios would have held up very well during the bear market. Indeed, the cumulative return of the 422 stocks in the S&P 500 index that are not in the technology sector are now above the level they were at the market peak in March 2000. My interest in the long-term returns of individual stocks was piqued by the experience of one of my close friends, whose father had purchased AT&T 50 years earlier, reinvested the dividends, and held all the firms spun off from Ma Bell. A modest initial investment had turned into a substantial bequest. Similarly, much of Warren Buffett's success was also attributable to holding good stocks over long periods of time. Buffett has remarked that his favorite holding period is forever. I was curious how investors would have performed if they did just that, bought a group of large capitalization stocks, and held on to them for many decades. Computing long-term buy-and-hold forever returns seems like it would be an easy task, but the reality proved otherwise. The returns on individual stocks available to academics and professionals assumed that all stock distributions and spin-offs were immediately sold and the proceeds reinvested in the parent firm. But this assumption did not match the behavior of many investors. I went back a half-century and investigated the long-term returns of the 20 largest stocks trading on the New York Stock Exchange, assuming dividends were reinvested and all distributions were held. To reconstruct these buy-and-hold returns was a time-consuming but ultimately extremely rewarding endeavor. To my amazement, the performance of the top 20, as I called this group of stocks, beat the returns of an investor who indexed to the entire market, which of course included all the new firms and new industries. After that preliminary investigation, I was determined to explore the returns of all the 500 firms that constituted the S&P 500 index when it was first formulated in 1950. This project yielded the same surprising conclusion. The original firms outperformed the newcomers. These results confirmed my feeling that investors overprice new stocks, many of which are in high technology and industries that produce new products, and ignore firms in less exciting industries that often provide investors superior returns. I coined the term the growth trap to describe the incorrect belief that the companies that lead in technological innovation and spearhead economic growth bring investors superior returns. The more I investigated returns, the more I determined that the growth trap affected not just individual stocks, but also entire sectors of the market and even countries. The fastest-growing new firms, industries, and even foreign countries often suffered the worst return. I formulated the basic principle of investor return, which specifies that growth alone does not yield good returns, but only growth in excess of the often overly optimistic estimates that investors have built into the price of stock. It was clear that the growth trap was one of the most important barriers between investors and investment success. Understanding which stocks did well over the last half-century helped answer the first of the two questions that I was frequently asked. To address the other, it was necessary to examine the financial consequences of our rapidly aging population. Having been born in 1945, I long realized that I was at the leading edge of the surge of baby boomers that would soon become a tidal wave of retirees. Investor interest in the impact of the population trends on stock prices was sparked by Harry Dent, whose 1993 bestseller, The Great Boom Ahead, provided a novel explanation of historical stock trends. Dent found that stock prices over the last century correlated well with the population between 45 and 50 years of age, an age that corresponded to peak consumer spending. On the basis of population projections, Dent predicted that the Great Bull Market would extend to 2010.
Sample complete. Ready to continue?